For more on the economy and inflation, I want to bring in Dana Peterson. She is the chief economist for the Conference Board, a global think tank, and Business Membership Association. Dana, welcome. Thanks very much for being with us. So I want to get your take, first of all, on the Fed's plans to implement interest rate hikes in the near future. Do you think this goes far enough in addressing inflation?
Well, certainly the Fed does have a role to play in addressing inflation. Interest rates right now are at zero, so it makes sense that the Fed should be helping to lower inflation by raising interest rates. Of course, this is going to slow the economy a bit, but that's really the point. The fact that many people are working means that we are already well close to or even having achieved full employment. And inflation gauges are well above the Fed's 2% target. So it makes sense that the Fed should remove some of the very accommodative monetary policy that is in place.
Well, how would the impacts of interest rate increases be felt among businesses and consumers?
Sure. Well, businesses that are indebted would probably feel it in terms of higher borrowing costs. Certainly, the tech sector is one business that we can think about that's very vulnerable. In terms of consumers, certainly anyone who's looking to buy a home should probably do it now before mortgage rates rise with rising monetary policy interest rates. But still in all, when you think about the impact of inflation on the average consumer, people are losing their power to purchase whatever they desire. As things get more expensive, they're either shifting away to cheaper goods and services, or they're stopping buying. So it's important that inflation is tackled such that we don't see a halting in consumption and growth.
Well, are there any other options or solutions that could help slow this inflation we've been seeing over the last few months?
Well, certainly the evolution of the pandemic is very important. Some of the inflation that we're seeing is directly linked to the pandemic itself. So, for example, many people can't go out and engage in services such as hotels and restaurants and travel, amusements. And so they are staying at home and they're buying goods. So there's very strong demand for things, for goods, but not enough supply of those goods. And so essentially, when you have more demand than supply, you're going to see prices rise. So certainly as the pandemic becomes less of a problem for the economy and health-wise, more people can go out and engage in in-person services and take the pressure off of goods and consequently the prices for those goods.
Well, given what you just laid out then, Dana, when do you see things reaching a peak and declining?
Well, we anticipate that in the first quarter of this year, so we're already past with January, but February or March, we could potentially see the peak in terms of year-on-year increases in inflation, and then the rates of inflation slowing over the course of this year. But we could still see prices well above the 2% target that the Fed prefers to have in order to have strong growth and low inflation.
So many Americans feeling the effects of these higher prices. Dana Peterson. Dana, thank you very much for your insight.
Thank you.